This is Nightly Business Report with Tyler Matheson and Susie Guerin. Brought to you in part by
TheStreet.com. Up-to-the-minute stock market news and in-depth analysis. Our quant ratings service provides objective, independent ratings daily on over 4,300 stocks. Learn more at TheStreet.com/NBR.
Good news, bad market. Stocks sell off sharply after a stronger than expected report on U.S. economic growth. Could an expanding economy prompt the Fed to cut back on stimulus sooner?
Twitter takes off. Shares jump 73% in the company's Wall Street debut. But does money-losing Twitter deserve a market value greater than 3/4 of the S&P 500?
And House of the Mouse, Disney's profits beat forecasts on strong theme park results. Can the entertainment giant keep it up? All that and more tonight on Nightly Business Report for Thursday, November 7th, 2013. Good evening, everyone. On this very busy day, I'm Tyler Matheson.
And I'm Sue Herrera, in this week for Susie Garib. Well, Wall Street was all over Twitter today. We'll get to that in just a second. But first, stocks sold off today following a stronger than expected report on economic growth that stoked fears that the Federal Reserve may start to pull back on its bond buying program. Third quarter GDP rose 2.8%. Expectations were for 2%. Couple that with a drop in weekly unemployment claims as everybody waits for tomorrow's October jobs report, and you have the recipe for a sell-off, and that's exactly what happened. The Dow falling nearly 1%, or about 153 points, to 15,593. A weak tech sector weighed on the NASDAQ, dragging that index down 74 points, and the S&P slid 23.
Well, that stronger than expected GDP numbers surprised economists on Wall Street, but analysts are warning that hangover effects from the government shutdown last month will likely temper growth in the fourth quarter. Steve Leisman has more.
Economic growth was hotter in the third quarter than investors expected, but that could be cold comfort in the months ahead. The government said gross domestic product rose by 2.8% in the third quarter, the one we just finished, well ahead of the 2% consensus and the best quarterly number in a year. But the data accounts for growth before the government shutdown and the controversial debt ceiling debate that many economists believe weakened growth in the current quarter. Still, it's better to have more momentum ahead of a slowdown than less. Here's where the growth was. Housing surged ahead by 14.6% at an annual rate. Durable purchases by consumers was up nearly 8%. Exports were up 4.5%. And inventories, there was a big inventory build, up $86 billion. Consumer spending, though, overall pretty weak at 1.5%. Business equipment purchases fell, and federal government fell by 1.7%, their spending. It's the strong growth in inventories, along with concerns about the shutdown, that makes economists concerned about the current quarter's growth. If businesses put too much stuff on the shelves in the last quarter, they'll spend this quarter working it off, which means fewer new orders. Together with the expected effects of the shutdown, fourth quarter growth is seen at an anemic 1.6%. One shot in the arm for global growth could be from Europe. The European Central Bank cut its overnight lending rate today amid concern about declining inflation. ECB President Mario Draghi signaled more measures could be on the way. There'll be far more attention paid to tomorrow morning's delayed October jobs report for clues of the outlook for growth and for Fed policy. For Nightly Business Report, I'm Steve Leisman.
And joining us now to talk more about the U.S. economy and her outlook for growth is Lindsay Piegza. She's chief economist at Sterne Agee. Lindsay, welcome. Good to have you with us. You heard Steve's report there. How strong was this economic report really? He suggests that once you scratch the surface a little bit, it was a little less than meets the eye.
Well, that's right. On the surface, the headline growth was quite impressive at 2.8%. This was the second consecutive quarter of above 2% growth. But when we look in the details, it paints a very different picture of the economy, especially when we look at the consumer, the key variable in the economy. Now, the consumer was already pulling back in the second quarter, falling down to 1.8% from 2.1%. But the consumer pulled back even further in the third quarter, falling to just 1.5%. Now, when we look at businesses, too, they're very much sidelined, hesitant to invest in equipment, structures, and employees. So this is one of those reports where certainly the devil was in the details.
So, Lindsay, did the market get it wrong then? The market sold off on the idea that the report was strong enough to perhaps change the Fed's bond buying program. It sounds like you would disagree with that.
Well, I think the market was a little jittered by the juxtaposition of headline strength and component weakness. So there's a fear that the Fed will look at that headline number and say, you know what, the economy is actually improving enough that we can begin to roll back accommodation. I do not believe that this is enough to suggest that the Fed will move away from their accommodative path. The Fed has very much focused on the labor market data rather than one quarter's growth data point. And so I think the market will eventually slough this off and realize that the Fed and their accommodative policies are here to stay for quite some time.
And labor market data, you just mentioned it, leads us to tomorrow and the jobs report. A lot of people thinking that jobs report is going to be soggier than some of the more recent ones. What is your prediction here on the high end and the low end?
You know, I'm looking for about 135, 140 in terms of headline non-farm payroll growth. Remember that jobs have been slow, job creation, I should say, has been slowing since the start of the year. At the beginning of the year, we were seeing plus 200,000 numbers. Now we've slowed to a pace of about 140,000, and I suspect that pace will continue to lose momentum as we go to the end of the year, maybe even slowing to a pace of 125,000. So clearly at this point, the current level of production is meeting the current level of demand. And with productivity outpacing growth, there's really no incentive for businesses to hire at this point, especially against the backdrop of added uncertainty given the shenanigans in Washington.
Yeah, that doesn't sound good going forward, though, then, Lindsay. I mean, it sounds as though even though the headline today looked like the economy was doing better and the recovery was on firmer footing, if you look underneath that and with what you just mentioned about job creation, it sounds like maybe this recovery is just lukewarm.
I think you're very much right. I think we're going to see this 2.5% range for quite some time, even carrying over through 2014. Now, one of the variables, too, that affected third quarter growth was inventories. If we strip out inventories from growth, we saw just 2.1%, or a tenth higher than what we saw at the end of the second quarter. So very much unchanged. And unchanged is not enough strength to suggest that the Fed is ready to roll back those monthly bond purchases.
All right, Lindsay, thank you very much. Lindsay Piegza, chief economist at Stern AG. Well, after all the hype, Twitter made its debut on the New York Stock Exchange, and it was a strong one. Shares rose 73% in its first day of trading, exceeding the expectations of many. Kelly Evans takes a look at what turned out to be an eventful day.
How much is 140 characters worth? The answer, it turns out, is billions. Twitter, the upstart social networking site that lets users exchange brief messages, photos, and videos, went public today and immediately became one of the world's most valuable companies. The shares were priced at $26 a piece, but jumped to $50 within the first few moments of trade at the New York Stock Exchange. While they settled a bit below that level, it still leaves Twitter valued in the range of $30 billion, bigger than most of the companies currently listed on the S&P 500.
We've had consistent, tremendous growth across the world, frankly, for the last several years. Over 230 million monthly active users now. I think we've got a tremendous set of thoughts and strategies to increase the slope of the growth curve. I would consider that some of them tactics, some of them broader strategies, in service to doing what I refer to as bridging that gap between the massive awareness of Twitter and deep engagement on the platform.
Today's action makes Twitter not just one of the biggest, but also one of the most successful IPOs in recent history. That's good news for Twitter and also for the New York Stock Exchange, which has now surpassed rival NASDAQ after it famously botched Facebook's listings last year in terms of tech IPOs. CEO Duncan Niederauer dismissed talk of another tech bubble and expects the pipeline of IPOs in this already busy year to keep growing.
The market's at a level where it makes sense to try to take companies out. The investors are receiving them pretty well. I don't feel that it's frothy. I think people are being pretty thoughtful about what they want to own, what they don't want to own. And then the market is conditioned that if it keeps working, I think the supply of IPOs will keep coming.
The challenge for Twitter now will be keeping investors happy, because at these prices, it's trading at 75 times 2013 revenue to date. That compares to just 20 times for Facebook and 4 times for Amazon.
At least one analyst at Pivotal Research Group has already downgraded the shares, saying they are now, quote, simply too expensive. For Nightly Business Report, I'm Kelly Evans at the New York Stock Exchange.
Well, IPOs like Twitter's today are beautiful when they work. That is when the stock opens smoothly and the price goes up. But it doesn't always happen that way, and sometimes after the initial flurry of enthusiastic buying, those shiny new shares sell off hard. Dominic Chu now with a lesson in the occasional madness of crowds.
Let's face it, most of us weren't in that select group of folks who got that coveted $26 IPO price for Twitter shares. An elite group of institutional investors and wealthy individuals were part of that action. So, should you rush in and buy shares of these hot IPOs whenever you can? After all, a lot of gains happen on that first day of trading. So it turns out recent history gives us examples of reasons you might want to wait just a little while if you didn't get that IPO price. For instance, take Yelp. The online reviews company had an IPO price of $15 back on March 2nd, 2012. Yelp shares soared and closed at $24.58. That's a gain of 64%. If you would have bought shares at the closing price, your investment would have fallen in value by 6% just 1 year later. Then there's internet radio company Pandora. It rose by 9% on its debut back in June of 2011. If you would have bought in at the close of first day trading, you'd have lost 39% of your investment a year later. Same goes for Groupon. The online daily deals and coupon site rose 31% back on its first day in November of 2011. If you rushed to buy it at the close of the first day of trading, you'd have lost 85% of your investment just 1 year later. Professional networking site LinkedIn is the only real bright spot. Shares more than doubled on day one back in May of 2011. And assuming you bought at the close, you'd actually have made money a year later, a whopping 5%. IPO trading is often filled with volatility, and that's why many veteran investors tend to stay away from them.
I would never buy on the day of an IPO. That's just not how I work. I wait until things have settled out and, people have figured out what it really is and all the energy, once the emotions come out of it, that's really the time I look to buy a stock like this.
And we all know what happened to Facebook. Shares lost half their value in just the first 3 months of trading. But it's worth noting that if you held onto shares of Facebook, Yelp, Pandora, and LinkedIn, you'd currently be making money. Groupon, on the other hand, is still trying to get back to positive. For Nightly Business Report, I'm Dominic Chu.
Consumer credit rose more than expected in September, but the Federal Reserve says Americans cut back on using their credit cards for the fourth straight month. Borrowing for cars and student loans rose by $16 billion, while credit card debt fell $2 billion. Consumer spending, which accounts for more than 2/3 of economic activity, grew at its slowest pace in 2 years in the third quarter.
Fannie Mae and Freddie Mac are close to paying back nearly the amount the government put in to rescue them during the financial meltdown. America's biggest providers of housing finance posted strong earnings in the third quarter as the housing market continues to recover. The gains will enable Fannie and Freddie to send the U.S. Treasury $39 billion in December, and that will finish repaying or come close to it the government aid they got when they were rescued in 2008. And it's expected that by early next year, the government will turn a profit on the $187 billion bailout of the two mortgage giants, which own or guarantee about 2/3 of all U.S. home loans. Well, the White House Budget Office says it will cost $2 billion to cover the back pay of the 850,000 government workers who were furloughed over that 16-day government shutdown. That's a cost that will be passed on to taxpayers one way or another. Closing national parks during the shutdown cost communities about $500 million in lost spending by visitors, and the Internal Revenue Service, of course, delayed $4 billion in tax refunds. The IRS now will need to delay next year's tax filing season by up to 2 weeks. The Obama administration says the shutdown and uncertainty over raising the government's borrowing cap will additionally curb economic growth in the current quarter.
Well, while everyone has been focused on Twitter, there are still budget talks going on which are trying to avert another shutdown. But today, Senator Lindsey Graham says those talks are deadlocked. Graham was quoted as saying the negotiations were stuck, not irreconcilably, but stuck, she tried to say. For more on the budget talks, let's join John Harwood. John, we've seen this movie before, and, the market was very volatile during that period of time. Are we in for another round?
Well, Sue, we have seen this movie not only before, but continuously for 2 years, ever since 2011, when they set up the super committee trying to get a deal for additional deficit reduction, but they couldn't get it because of this very simple equation. Republicans said to get a deal, we need to cut entitlements. Democrats said, OK, if we're going to cut entitlements, we need to raise taxes. Republicans have not been willing to go there. Now the question is there some sort of a deal that can evade that fundamental roadblock. And the way to do it is to shrink the deal very small, to make the entitlements not about Social Security and Medicare, the real hot buttons, but things like farm subsidies where you can get some bipartisan agreement, and make the revenue increases very small, not general tax increases, but some sort of user fees on specific sets of consumers of government services. And that's where we are right now, and we've got to see if we can get some sort of agreement to avoid a shutdown. Nancy Pelosi says she wants to get it done by Thanksgiving. The formal deadline that we've got for this round of budget talks is mid-December, but of course, there's nothing binding that occurs on that date. The real issue is going to be in January and February when government spending runs out and we got to raise the debt limit again. That's when we're going to find out whether we, in fact, are headed for the other kind of shutdown that OMB said today cost us jobs and government money.
All right, John Harwood, thank you very much. John Harwood reporting from D.C. for us. Well, for several years, trans fats have been disappearing from grocery aisles and restaurant menus. Now, the Food and Drug Administration is going to finish the job. The FDA announced today that it will require the food industry to gradually phase out all artificial trans fats, saying they're a threat to people's health. Scientists say trans fats can raise levels of so-called bad cholesterol, increasing the risk of heart disease. The heart-clogging substance was once common in the American diet, showing up in baked goods, fried foods, and microwave popcorn.
Coming up, a Dow component and a $1,000 stock post earnings after the bell. Could they set the tone for tomorrow? But first, a look at how international markets finished the day.
A pair of big-name earnings out after the bell, Priceline and Disney. Priceline earned $17.30 a share, beating estimates. Revenue rose $2.27 billion, also beating estimates. Shares are up after hours and are up, hold on to your hats here, 1,200% since the market lows of 2009. Sheila Dharmarajan joins us from the NASDAQ. Sheila, what is the big takeaway on Priceline's numbers?
Well, Tyler, the big takeaway is that the e-travel sector continues to show strength, and Priceline is undoubtedly the big leader. The company posted strong earnings and sales growth for the third quarter, with bookings growing 37.5%. They also projected double-digit growth for the fourth quarter as well. The company is continuing to diversify in a lot of different offerings, whether it's hotels or car rentals, also air travel, also internationally as well, with an emphasis on the Asia-Pacific region and Latin America. There was also a change at the C-suite at the top. Jeffrey Boyd, who's been a longtime CEO of the company, will be taking over the chairman role. Darren Houston now taking over as CEO, but Priceline firmly in that $1,000 club after the bell.
Sheila, thanks so much. Dow component Disney beating the street as well. Disney earned 77 cents a share, beating by a penny. Revenue up 1.5% to $11.6 billion. But shares fell right after the news. Julia Boorstin follows Disney and joins us now from San Francisco. So what should investors be focusing on right now, Julia?
Well, Sue, Disney's results really were better than expected on growth across the board, record results. And the studio showed strength, consumer products showed strength, and even the interactive division swung to a profit, which was unusual for a division that's only been profitable one quarter in the past. Now, the reason the stock is trading lower seems to be on expectations about the Media Networks division, Disney's biggest division. The thing here is that the studio had warned, the company had warned that there would be some issues with deferred revenue from the prior quarter, so it's not unexpected. And then Disney says that without those issues of deferred revenue, it would have showed an increase in operating profit on higher affiliate fees and advertising, but that seems to be what's impacting the stock. But Sue and Tyler, I have to tell you, there was a lot of optimism, especially about digital. Bob Iger weighed in on Marvel and said that with a new Marvel Netflix deal that was just announced today, it would really be a win-win for the company, producing original exclusive content for Netflix, calling it a breakthrough. And on the heels of Twitter's IPO, he said he's very bullish on both mobile and social, saying both things are great for Disney.
Very quick thought, if you would, Julia, on Twitter, which you covered today. You were outside their headquarters. What's the buzz out there?
Well, the buzz here in California seems to be very positive. There were 1,000 employees gathered really early this morning to watch CNBC and watch Dick Costolo's interview on our air. And people have gone back to work, but they will be celebrating again when CEO Dick Costolo arrives for a big meeting at their headquarters.
All right, Julia, thank you very much. Julia Burston reporting from San Francisco for us. Well, there is some good news for JCPenney for a change, and that's where we begin tonight's market focus. The retailer's sales rose nearly 1% in October for the first time in close to 2 years. Penny credits the return of deep discounts and popular in-house brands, including St. John's Bay and Stafford Home Goods. Well, home goods sales, by the way, rose more than 50% from a year ago. The stock surged 5.5% to $8.13. Good day for Penny's. Wendy's narrowed its third quarter loss to $2 million from $26 million a year ago. More customers snapped up its new pretzel bacon cheeseburger and pretzel pub chicken sandwiches, driving sales higher at restaurants open at least a year. But lower than expected quarterly revenue worried investors. Shares down, though, today, about 11.5% to $8.05. And moving on, Toll Brothers strengthening its holdings in California. It's buying the home building business of Chappelle Industries for about $1.6 billion. The move gets Toll access to some wealthy, high-growth markets such as Metro Los Angeles, Orange County, and the Bay Area of San Francisco. Shares up a fraction to $32.68.
Qualcomm was one of the biggest drags on both the S&P 500 and the NASDAQ 100 indices today. Increasing competition overseas caused the leading mobile chipmaker to post earnings short of Wall Street's estimates. The company also gave a weak outlook for the current period. The stock tumbled almost 4% to finish at $67.09. Tempur Sealy was one of today's big stock winners. The mattress maker's third quarter results comfortably beat Wall Street estimates, boosted by a bounce back in North American sales. The stock jumped 12%, finished at $44.96.
And some more bad news drove down shares of Tesla today. Its Model S electric car caught fire today for the third time in 6 weeks. There have been no injuries in any of the fires, unless you count the injuries suffered by Tesla's once high-flying stock. It fell for the third day in a row today after rising by more than 400% early in the year. But now, in addition to those fires, there are concerns about a battery shortage as well as the costs Tesla will incur as it builds more cars. The automaker has become lately a favorite among short sellers who believe the stock is still overvalued. Shares continue to fall since its earnings report Tuesday, down another 7.5% today to $139.77. And shares of Men's Wearhouse took off today after an activist investor took a roughly 10% stake in the company. Eminence Capital, large hedge fund, is encouraging Men's Wearhouse to solicit bids and increase its shareholder value. The clothier Joseph A. Bank, along with the private equity fund of Golden Gate, have offered $48 a share to acquire Men's Wearhouse, but the company rejected the bid, calling it too low. The stock up 7% today to $45.43.
Up next, in the hunt for yield, commercial real estate investors change their way of thinking. You may want to take some notes. That's straight ahead, but first a look at commodities, treasuries, and currencies. Since the recession, commercial real estate investors have largely stuck to the safety of major U.S. markets. But a new report shows that that's all changing thanks to new cash and new opportunities. Diana Olick reports.
New York, San Francisco, Boston. These top-tier markets have all been safe havens for commercial real estate cash as investors licked their recessionary wounds. That is now turning around.
Tailwinds are the new headwinds. So I think there's more positive momentum helping than what we've had in the last few years.
That momentum comes in the form of cash, foreign and institutional investors, private equity, and REITs, not to mention that banks are lending again and the commercial mortgage-backed securities market is on the rise. Market-wise, while San Francisco still sits at the top of PwC's hot list, Houston moved up to second and Dallas jumped 4 spots into the top 5. Denver, Nashville, and Austin are also seeing much more investor demand. A noticeable dropout, Washington, D.C. It fell from 8th to 22nd place in investor interest. You can thank its local employer for that.
It's been the 18 months of noise regarding the budget debate. And and shutdown, sequestration, all of those are symptoms. But the bigger story, I think, in the eyes of investors is just that massive uncertainty.
So why is the unglamorous warehouse sector so popular now? You're looking at it, e-commerce. As shopping moves online, retailers need distribution centers near big cities, especially as more consumers demand their goods overnight. And from the cities to the sectors, industrial is #1, surpassing the apartment sector for development and investment prospects. Its warehouse subsector is driving the gains.
It's had a major impact on the warehouse sector. Thank you.
Chambers Street, a New Jersey-based REIT, went public this year. It focuses on the warehouse space.
We see now that other companies are adding more and more of a direct-to-the-customer component to their warehouse operations.
As competition for the space grows, vacancies are dropping, rents are rising, and yield is looking very attractive. All the more reason for commercial cash to store itself in the sector. For Nightly Business Report, I'm Diana Olick in Washington.
And finally tonight, with Twitter going public, we thought we'd look at the first ever tweet by founder Jack Dorsey way back in 2006. It read, "Just setting up my Twitter." Wow.
Pretty historic day, right?
And lots of other famous tweets, including the way we sort of got first hint that Osama bin Laden's compound had been attacked.
Yeah, absolutely. That does it tonight for the Nightly Business Report. I'm Sue Herrera. Thanks for joining us.
And I'm Tyler Matheson. Have a great evening, everybody. We'll see you back here tomorrow night.
Nightly Business Report has been brought to you by
TheStreet.com. Up-to-the-minute stock market news and in-depth analysis. Our quant rating service provides objective, independent ratings daily on over 4,300 stocks. Learn more at TheStreet.com/NBR.
I'm Tyler Matheson with a Nightly Business Report news brief. Twitter wowed investors, but stocks still had their worst day since August. A sell-off followed a stronger than expected report on economic growth. It rose 2.9% in the third quarter. That stoked fears that the Federal Reserve may start to pull back on its bond buying program. The Dow fell nearly 1%, or about 153 points, to 15,593. A weak tech sector weighed on the NASDAQ, dragging down that index by 74, and the S&P 500 slid 23. Twitter was, of course, the big exception. Its shares jumped 73% in the company's Wall Street debut, exceeding the expectations of many. The price of oil fell 60 cents to $94.20 a barrel. And tune in to Nightly Business Report here on your public television station.